CPF 2025. Secrets secure your retirement. Now, hi everyone. Today, we're uncovering the latest CPF updates for 2025. Everything you need to know to secure your retirement and make the most of your CPF savings. If you live in Singapore and want to stay ahead of the game, this video is for you. Section 1. Understanding the Basic Healthcare Sum, BHS, for 2025. Every year, CPF adjusts the Basic Healthcare Sum, or BHS, which is the maximum amount you can hold in your MediSave account. Starting January 1st, 2025, the BHS is set at $75,500 for all CPF members aged 65 and below. If you're under 65, your BHS will be adjusted upwards every year to keep pace with rising healthcare costs and increasing life expectancy. But once you turn 65, your BHS will be locked in. No more increases. So if you're younger than 65, it's important to plan for these annual increases, especially if you're thinking about topping up your MediSave. Of course, government policies can change, so keep an eye out. The retirement age keeps inching up, so never say never. Section 2. Should you bulk up your CPF? Should you bulk up your CPF savings? Well, the answer depends on your personal circumstances. For my wife and me, here's why we're choosing to grow our CPF. First, we've lived through multiple economic crises in the 80s, 98, 2008, and even recently in 2020. Our government has learned and built reserves, and we view CPF as our personal safety net. Second, CPF ordinary account savings become liquid at 55, while still earning a solid 2.5% compounded interest. Third, CPF savings can be passed on to your loved ones. It's part of your legacy. Fourth, CPF growth is deterministic, meaning it's not dependent on market ups and downs. Fifth, the yearly CPF interest we earn can support our lifestyle. And lastly, it provides priceless peace of mind. Section 3. CPF special account closed in 2025. What now? Big update. If you're 55 and above, your CPF special account closes in 2025. What to do with your SA funds? That depends on your financial plan. For us, we have achieved our goal of a combined CPF savings of $4 million in 2025. As for the special account funds, since they are part of the total, we'll let them transfer into our ordinary accounts. With stock, property, and crypto markets looking so vibrant, some might say keeping funds in CPF seems conservative. But for us, it's about peace of mind. Section 4. Should CPF funds be invested in Singapore stocks? Morgan Stanley recently reported that investing half of CPF's $30 billion annual growth into the local stock market could lift stock valuations by 20%. Currently, CPF funds are invested in Special Singapore Government Securities, SSGS, guaranteed by the government. This means your CPF interest is safe and not affected by GIC's investment performance. If the government invests CPF money in stocks but still guarantees CPF interest, I might support it. Personally, as a cash flow-focused investor, I'm cautious about gains that only exist on paper. CPF's top priority is capital preservation, especially for members nearing retirement. I'd be convinced if higher stock valuations came with increased dividends and CPF interest rates. For context, Malaysia's pension fund allocates 24% to equities, while Singapore's CPF funds only 5%. Are Malaysians better off? That's unclear. For now, we'll wait for the government's review on enhancing our local stock market. The Singapore government, through the Monetary Authority of Singapore, MS, launched a 5 billion Singapore dollar equity market development program, EQDP, in February 2025 to strengthen the local stock market. This initiative involves mass partnering with fund managers to invest in Singapore-listed equities, with an initial 1.1 billion Singapore dollars allocated to Avanda Investment Management, Fullerton Fund Management, and JP Morgan Asset Management. The program aims to increase market liquidity, attract investors, and encourage new companies to list on the Singapore Exchange, SGX. The program has a preference for fund strategies that focus on small and mid-cap companies, aiming to provide them with greater visibility and access to capital. Section 5. How big should your financial safety net be? A financial safety net helps cover unexpected expenses like medical bills, emergencies, or economic downturns. There's no one-size-fits-all answer for how big it should be. For us, CPF savings are a reliable safety net we're steadily building. At $4 million, CPF is our second largest asset, just behind property. What does it give us? Priceless peace of mind, a steady income stream. This year, CPF interest earned was $128,000, partly thanks to high-yield treasury bills. 2 golden income taps during retirement. An asset to leave to loved ones through the ordinary account. We plan to cap the safety net at $4 million, then use the interest for spending, gifting, or investing. So don't ignore your CPF savings during good times. Build it early and steadily while you work. Section 6. Mindset Change with Age, a K71 story. Investor AK71 plans to top up his retirement account to the enhanced retirement sum at age 55. His reasons? A steady cash flow that isn't tied to markets. Simplicity as he ages, avoiding constant investment changes, preparing for potential loss of mental capacity to manage his portfolio. Like me, AK71 sees CPF life not as an investment or legacy, but as an annuity and insurance product, a hedge against outliving your savings. His mindset shift came early at 53, 10 years younger than me. As we grow older, we become more conservative, focusing on wealth preservation and steady cash flow. Since I have children, I also want to maximize CPF life so I don't have to tap into other assets meant as inheritance. Section 7. CPF top-up for tax relief. It's that time of year again. Many are looking to reduce their income tax. Personally, I think it's better to pay tax than not. It means you're earning well. One common way to get tax relief up to $8,000 is by topping up your MediSave and special accounts if you're under 55, or your retirement account if you're 55 and above. Here's the tax savings you get. At 24% tax bracket, $8,000 top-up saves you $1,920. At 15%, it's $1,200, and so on. My wife and I topped up our retirement accounts to the enhanced retirement sum back in 2016. So we no longer get tax relief. But that's okay. Our top-ups earn 4% interest compounded annually, generating steady interest income even after retirement. Section 8. Mr. and Mrs. Teo, powerful dividend accumulators. Meet Mr. and Mrs. Teo, 63 years old, powerful dividend accumulators. Their passive income this year includes dividends, $51,821, rental income, $21,000, CPF interest, $67,072, including T-bills bought with OA funds. Treasury bill interest, $14,913. Mr. Teo shares 3 secrets to growing CPF savings. Maximize your contributions and let them compound over time. CPF rewards steady contributions with consistent interest. Don't owe CPF money. The Teos initially used OA funds for property, but refunded it by age 50, letting CPF earn 2.5% interest annually. Stay employed so your employer contributes up to 17% of your wage ceiling, growing your CPF further. Bonus, use the retirement account after 55. The government guarantees 4 to 6% compounded interest and manages lifelong payouts. Closing remarks. Don't overlook your CPF in your financial plan. It's a powerful wealth builder and safety net. Start early, contribute regularly, and build a strong foundation for your retirement. Thanks for watching. If this helped you, please like, share, and subscribe for more insights. See you next time.